Welcome to our introduction to international trade finance, a critical component of global commerce that facilitates the movement of goods and services across borders, encompassing financial instruments, institutions, and arrangements that bridge gaps between exporters and importers. It provides the necessary liquidity, credit, and risk mitigation mechanisms, such as letters of credit and trade credit insurance, allowing exporters and importers to confidently engage in international transactions despite different legal systems. Trade finance bridges the gap between when goods are shipped and when payment is received, significantly reducing counterparty risks, settlement risks, and information asymmetries in cross-border deals. This field encompasses various forms, including letters of credit, trade credit insurance, factoring, forfaiting, and supply chain finance, often involving multiple financial institutions like commercial banks and government agencies such as export credit agencies. International trade finance is crucial for supporting global commerce by reducing risks, improving access to liquidity, and connecting the real economy of trade and supply chains with broader financial markets. Without these financing mechanisms, international trade would be limited to cash transactions or advance payments, severely limiting global economic activity and preventing small and medium-sized enterprises from participating in supply chains. Key reasons for its importance include risk mitigation through insurance and guarantees, liquidity management via tools like factoring, and trust building between trading partners operating under diverse legal frameworks. It also supports economic growth by enabling small and medium-sized enterprises to participate in global supply chains, access new markets, and optimize working capital. Furthermore, international financial institutions like the World Bank and IMF use trade financing programs to stabilize economies during crises, providing liquidity and preventing disruptions. For instance, during the COVID-19 pandemic, institutions like the International Finance Corporation and Asian Development Bank provided crucial liquidity through targeted programs to prevent supply chain disruptions in vulnerable regions. Several parties are typically involved in international trade finance transactions, each playing a unique role to ensure transactions are financially sound, transparent, and secure. These include the exporter, who ships goods to the foreign buyer, and the importer, who orders, receives them, and often issues a letter of credit or arranges payment. Issuing banks handle letters of credit on behalf of the importer, while advising or confirming banks in the exporter's country verify the authenticity of documents and may add their guarantee. Export credit agencies like the US Exim Bank or UK's ECGD provide insurance and guarantees to exporters, encouraging participation in international trade by mitigating payment risks. Freight forwarders and customs agents manage logistics, shipping, and documentation, ensuring smooth cross-border movement of goods while complying with international regulations. Multilateral institutions, such as the World Bank and its affiliates, promote access to trade finance in developing markets, helping emerging economies integrate into global trade. This multi-party system ensures that trade transactions are financially sound, transparent, and secure for all participants by reducing counterparty risks and transaction costs. Common methods include letters of credit, where a bank guarantees payment to the exporter upon presentation of compliant documents proving shipment. Documentary collections involve banks releasing documents to the importer against payment or acceptance of a bill of exchange, less secure than LCs, but more cost-effective for established relationships. Open account trading ships goods before payment, common for trusted long-term partners, but exposes exporters to higher default risk if the importer fails to pay. Advance payment means the importer pays before goods are shipped, shifting most risk to the importer, but ensuring immediate liquidity and certainty for the exporter. Factoring and forfaiting involve exporters selling their receivables or bills of exchange to a financial institution at a discount for immediate cash flow and smoother operations. Export credit and insurance, provided by agencies like Exim Bank, mitigate payment risk and enhance access to finance, particularly for SMEs entering new international markets. Supply chain finance optimizes working capital for suppliers based on the buyer's strong credit strength, leveraging technology for real-time visibility and efficiency. International trade finance is a vital component of global financial markets, intersecting with banking, capital markets, foreign exchange, and emerging technologies. Commercial banks dominate short-term trade finance through letters of credit and collections, while corporations use capital markets by issuing bonds or commercial paper to finance trade activities. Foreign exchange markets manage currency conversion and provide hedging instruments like forwards and options to mitigate exchange rate risk in international transactions. Technology and fintech, including digital platforms, blockchain, and AI-driven credit scoring, are transforming efficiency, transparency, and access in trade finance. Global institutions like the WTO, IMF, and World Bank ensure the flow of trade credit across borders, reinforcing stability and integration within the global economy. In conclusion, international trade finance is the financial lifeblood of global commerce, providing mechanisms for secure transactions and linking the real economy with financial markets. As global trade evolves, innovations in digital platforms, sustainable financing, supply chain integration, and AI will continue to shape its future and complexity.